Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
Let's bring in right now Frank Sorrentino. He is chairman and CEO at ConnectOne Bank. It's NASDAQ traded, the ticker CNOB. And Frank, wow, what an insane week or two or three, or how do you deal as a banker with the rates volatility like this?
Yeah, how about a year? How about an insane year?
Yes, that's fair.
It's been an interesting environment. Certainly there are lots of things at ConnectOne that we try to control. But what the Fed policy is and where rates are going and how the market reacts to those rates is something that's somewhat out of our control. And so, yeah, it's been very challenging, not just for ConnectOne, but for banks in general.
Frank, what sectors of the economy are you seeing actually absorb the effects of the Fed tightening? And what areas are maybe still waiting for the monetary policy lags to kick in?
Yeah, I think when you look at it, I think that question would be answered differently from different bankers from different parts of the country. But certainly here in the New York metro market, at ConnectOne, we certainly see that the vast majority of our clients are absorbing those rate increases. And it's showing up in lots of places, right? Rents are up. If you've been to a restaurant lately, you see that the price of a meal is up. And I know, there's inflation component to all this, but that's part of the rate increase. And so it's building into the economy. And I think we're seeing it in higher prices, higher costs, and it's being incorporated in every aspect of our economy. I think our builders, for one, are for the first time in a very long time having to figure out what are the interest rates and what's the interest component of a construction project, but they really didn't have to think about that too much in the past. So all these things are leading to higher prices and definitely a more normalized environment where interest has a cost.
But nothing normal about the current housing market, right? I mean, in terms of residential, especially previously owned homes, that market seems to have grind to a halt.
So at ConnectOne, we do a lot of new home building. We don't see a lot of the mortgage refinance, although we do see some. And yes, for the existing home market, it's a difficult place today because folks have low interest rate loans. They really don't want to move and give up that rate, or they can't. But on the new housing front, we do see a level of optimism where, as you know, in the New York metro market, and by the way, as the nation, we are underhoused, right? There's just not enough apartments, not enough housing units. And so new product that's coming to the market is able to absorb the higher costs due to inflation, the higher costs due to interest rates, and there is a ready market buying that product.
We hear all the time that builders offer incentives, they're buying down points or they're giving lower rates. And I was talking to a land developer the other day who said they are giving builders incentives. And I thought, where does the buck stop? Because obviously at some point, somebody's got to pay the price.
The end consumer pays the price, right? So we're certainly seeing prices have somewhat leveled off relative to new home product. We're also seeing it in the rental market. Rents continue to go up over the last couple of years at a pretty drastic clip. We are, however, starting to see that level off, and there are some places where we are seeing some level of concessions. So I do think we're getting to a more normalized place. And I think that's part of the message that came out of the Fed, is that the economy is beginning, as first question you asked, beginning to absorb a more normalized rate environment.
Your notes, it says that you think the economy is on a soft landing trajectory. I'm wondering what you see as the CEO of a bank that deals with small businesses and deals with lenders. What are you seeing that maybe some of the other Wall Street prognosticators that are still calling for a recession are missing?
Well, look, I start with employment, and in all the markets that ConnectOne serves, we're seeing a shortage of people to fill jobs. We're seeing very, very low unemployment. We're seeing a strong labor market overall, rising wages, and that to me underpins everything. People that have a job, feel good about their job, and see their wages rising can absorb those, changes in the economy, higher interest rates, and everything else. They can absorb rising rents. They can absorb higher costs of food and housing and everything else. And so, to me, that's the foundation on which the economy is built. And no one's been able to convince me that that's going to change anytime soon.
I just want to ask about deposits. How sticky are they? How do you fight deposit flight? Is it just a question of the rate you offer, or do you think that depositors also really look into services and the culture? I mean, what's your view on that?
Look, I think there was definitely back in March a reorganization of the deposit market versus large banks, small banks, medium-sized banks. Where people had funds, the entire notion that interest wasn't being paid on certain types of accounts, FDIC insurance coverage, lots of questions, lots of things came to the fore in those few weeks of March and early April. I think the market overall, though, has pretty much settled out, and people are pretty much staying where they are. There is the ease of being able to move money from bank to bank. But folks, ConnectOne is mostly a business-oriented bank. People come to us not necessarily for the highest rate. They come to us for services. We have clients who have multiple types of businesses with us. And so rate is not the number one thing. That doesn't mean we're not going to pay a market rate, but it does mean that folks are making decisions in banks like ours relative to things like service and availability and the ability to talk to decision makers and what the other side of the transaction looks like if there's a loan there or a business loan or something else. So I think things in general have stabilized. Keep in mind, however, beside the Fed raising rates, they've also been shrinking the money supply and shrinking the Fed balance sheet, right? Earlier this year, we saw for the first time since 1949 that M2 actually shrunk, and the Fed is on a track to continue to reduce the size of its balance sheet. That's putting a lot of pressure on banks and other financial institutions.
Frank, great to get your views. Really helpful context there. Frank Sorrentino is the chairman and CEO of ConnectOne Bank.
You're listening to The Ting. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Katie Greifeld in the studio with me, Paul Sweeney on an extended lunch break right now. I'll be back at 3 p.m. Let's talk right now about, there was a Bloomberg story the other day that said the shrinking $1.3 trillion CLO market is bad news for bankers. And people have been talking about this market as if it's hit a speed bump or maybe even frozen. Mm-hmm. Got a guest here in the studio says, not the case, not so fast. Thomas Majewski is the CEO of Eagle Point Credit Management. He's got experience across the street from JP Morgan to Bear Stearns and Mother Merrill. And then obviously some smaller shops as well. Tom, thanks so much for your time. What's your view of the CLO market right now?
Great. Thanks for having me, Matt. The market's far more vibrant, I think, than the headlines suggest. There's always ways you can cut the data, a lot of different ways. The actual new issue volume for CLOs remains quite robust. However, the activity of resetting or refinancing, which is where you go and reopen an old deal and re-extend it, that's slowed down significantly. So total volume is down, but the actual new volume created is not too far off from where it was last year.
Well, let's talk about one of the ways in which they cut the data. About 40% of issuers in this area of corporate finance are yet to price a new deal this year. When you hear a stat like that, what's your reaction?
It's an indication perhaps of the state of their performance and a state of the market broadly. Markets, investors in CLOs, including us, have certainly gotten far more selective. In a raging bull market, there was an old saying, two guys in a Bloomberg could print a CLO. The market needs a little more robust than that. And now that we have over 20 years of data for people's performance, it's easier to separate the top from the worst. That 40 is out of about 120. So the other way to cut that is 2/3 of the market is operating kind of business as usual.
What's your view on financial conditions right now? It seems like they were getting tighter. The Fed was letting the market do its job until the Fed told the market that's what it was doing, and now the market isn't doing its job anymore. So how do they look to you?
Well, the underlying assets in CLOs are syndicated loans, small pieces of big loans to big American companies. They're floating rate and senior and secured, which means in event of a problem, there's less risk of loss. The loan index is up about 10% this year, versus the Bloomberg Ag is roughly flat for the year, down a tiny bit. That's investment grade versus loans are below investment grade. And there was a lot of talk early in the year with increasing interest rates, and loans are floating rate, that companies wouldn't be able to service their debt. There was going to be a recession coming and rates are going higher. As an investor, it's great we get a floating rate. For the companies, on the other hand, they have to pay that floating rate. The reality, though, is profits and revenue at most below investment grade companies continue to go up in this economy. Citibank just put out research that said more companies are getting upgraded than downgraded. And while there are some defaults, the default rate over this year has been roughly half the long-term average. So it's the economy's doing, or at least the corporate borrower in leveraged finance is doing far better than the headlines would suggest.
Okay, so overall, not too much consternation over increased interest expenses and servicing that debt. But for the pain that you are seeing, there certainly are companies out there that are struggling with that. Do they tend to be concentrated to any industry, or what is the common denominator there?
Thankfully, it's not one industry. Sometimes we've seen that. Maybe in 2015, we saw energy pose a problem. The problems where they do exist, and they're quite few, are generally broad-based. In many cases, it's due to either a company that just put on a little too much leverage, or a company maybe with a less skilled management team would be some of the biggest things, or change in regulation. One company recently, Envision Healthcare, which defaulted, had a number of businesses. Every business line was coincidentally infected by adverse changes in regulation for them. So just a perfect storm against that company.
You think that regulatory capital reasons are the problem, that some banks have, I guess, bought other things than AAA CLOs, but you point out Japanese banks are still big buyers. Why is that? Why are Japanese banks notable here?
Absolutely. Japanese banks remain some of the largest buyers of CLO AAAs and holders in the world. U.S. banks also own meaningful amounts. Some of the largest money center banks own more than 1% of their gross assets in CLO paper. Frankly, we joke that had some of the regional banks that are no longer with us bought floating rate CLOs instead of mortgages, they might still be with us, in fact. But the banks in the U.S., there's sometimes some stigma with the name. It's still a CLO. That sounds like a CDO. Many of those Japanese investors have been in the market for over 20 years. And across their AAA portfolios, what they've seen is everyone has paid off at par. There's never been a default on any bond they bought in the CLO market.
And let's talk a little bit about what happened in March. Like you said, maybe if those banks had maybe shifted out of treasuries into CLOs, we'd still be with them. But when we talk about what happened in March, we talk about it as a boon to private credit. Certainly private debt has been on fire this year. Where does the CLO market sit in relation to what we're seeing in private credit?
Sure. So we're a net beneficiary of that in a number of ways, frankly. Banks in general are putting less capital out as Basel III comes to fruition. Higher capital charges on banks are unambiguously trends in the market. The steady hand of private credit, which is typically in the form of private equity style funds, not short-term funds with redemptions, but long 10-year funds that can see a credit through from start to end. A lot of capital going in there. They've frankly bailed out a number of CCC rated syndicated loans and taken that out of the syndicated loan market, brought it to private credit as one thing. And another thing we've seen a real increase in, and it's an opportunity we're very interested in and have been deploying a lot of capital in, are something called regulatory capital relief transactions for banks. This is where a large bank will take a portion of their corporate loans or their auto loans or their fund subscription line loans even, and put them in a synthetic securitization, some very loaded words there, but a good way to raise capital, and they can basically transfer the risk of owning those to investors, basically a way to raise capital without having to go to the stock market and do a secondary offering. The reality is over many years, those investments have done very, very well. And what we're seeing is banks are seeking more and more capital, knowing they're going to be facing higher capital charges. They're coming to that market with greater frequency.
But the private credit market is one that banks are, it seems like they're losing that business to almost a shadow banking group of lenders. Is that market, even though, I mean, you point out they're long-term lenders, they aren't facing like immediate redemptions in a lot of cases, but there's not a lot of regulation there for how much business they're doing. So does that look like a place where regulation is going to grow into?
The good part about it is it's a steady hand.
Yeah.
And what goes wrong with banks is people take their money out. You and I can take our money out of our banks today with no consequence, except for the person in line after us, perhaps. Having these credits, even if there are riskier credits some cases in private credit, or maybe a little more leverage, having a small number of owners in that loan, each with a long-term mindset and a steady hand, I think is net beneficial. The investors in those vehicles typically are large, sophisticated pensions and insurance companies. So the investors getting involved in these underlying funds that are making these private credit loans are quite sophisticated themselves.
Okay, so we don't have much time left with you, but I could see regulation being a potential risk here. Talking to you, everything sounds pretty rosy, but if you take a look at the CLO market overall, where else are you seeing risks lurk?
Some of the risks continue to be, frankly, the biggest thing is the change in regulation and the impact on companies. I cited that one company before, something that makes like Medicare reimbursement slower or things like that, a regulation which might be a very valid regulation, then has an impact and changes a company's behavior. Overall, things that people often talk about, the wall of maturities in loans has been pushed way out, frankly, and the ability of companies to service their higher debts remains quite strong. Idiosyncratic risk is probably the biggest area that we look at. And then probably when we think about in our risk management meetings, frankly, continuing to look at our counterparties. One of the things we look at are what's the credit default spread pricing on banks that we do business with. While right now it seems most banks are on steady footing again, that can change very quickly. So we keep our eye out at the margins. We don't see a large systemic risk facing us, but no one was talking about a banking crisis in January of this year.
Absolutely. Thomas, thanks so much for your time. Really appreciate it. Thomas Majewski is the CEO of Eagle Point Credit Management. If you want more from him, he's going to go on Bloomberg Television in a moment and talk a little bit with Lisa Abramowitz about this as well.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Greifeld here with me in the Interactive Brokers studio. Paul Sweeney is out today. Well, he'll be back.
Yeah.
But not until 3 p.m. He's taking an extended break right now. Dina Ting in the house as well. She is the head of Global Index Portfolio Management Team over at Franklin Templeton ETFs, and she will be a guest on our on next week's ETF IQ program. That's on Bloomberg Television every Monday at 1 p.m.
So this is the warm-up.
This is a deep tease, basically. Dina, just before we get into the important stuff, I wanted to address a story that Katie and Eric Balchunas, they don't think it's that important, but I think it's very interesting and kind of a big deal, and that is a big push by regulators to shift to T+1, to faster settlement, is going to drive up costs and create a lot of operational challenges for ETFs. What do you think about this drive to move to, at some point, we'll be on T. We'll just settle as soon as you make the transaction.
Yeah, I think all changes always have repercussions, right? So in the case of T+1, I think at the end of the day, when everybody is prepared for it, it should not be causing an issue. I've seen an example in India where they moved from T+2 to T+1 earlier this year, and everybody was worried, especially because India, the currency is restricted currency, is a little bit more difficult. So I would imagine with more preparation in the US dollar, in the US especially, that it's less of an issue. And I don't know if you're aware, but in China, it's actually T+0.
Wow.
So,
no kidding.
yeah.
Good for them. Yeah, the concern is actually international settlements. So there are many U.S. listed ETFs that are going to have to be settling +1, but they hold, ETFs that hold European assets, for example, or international assets that settle +2 or +5. How do they square that circle?
Yeah, so those are the balancing act that a portfolio manager has to do, right? So when you're investing in the global markets, they all have different settlement cycles. So, and if you're in the midst of rebalancing, how would you balance something that settles in 3+3 if your funding is coming in at even longer settlement than that? But it's nothing unusual. So it's just about like, how would you handle the mismatch between where you're getting your funding versus where you're going to deploy that particular cash, right? So if you think about your example, so if let's say you're investing in European countries and you're buying a US equity, right? So the US equity will settle T+1, but let's say to buy that US equity, you require funding from selling the European equity, then you have to shorten the cycle of that one in order to be able to fund. Or you can have a line of credit to kind of handle that. So it's one of those things that at the end of the day...
It is complicated.
Yeah, gosh. Good thing that I, the end investor, probably don't have to worry about this, right?
It's true. Like that's why you trust your money managers.
Well, unless you take a hit on the margin, she's going to have to pay a higher fee, frankly.
Perhaps, yeah.
Perhaps.
All right, Franklin Templeton ETFs. What are you guys pumped about?
So we are looking at dividend tilt strategy. So we're pumped about that strategy because very rarely a strategy that focus on dividend focus beyond just dividend. So a lot of the strategies out there, all they care about is a higher dividend yield, right? But in reality, when you only singularly focus on higher dividend yield, you forget that you may be underperforming in some periods by significant amount, likewise. So the tracking error between your investment universe and your strategy could deviate quite a bit. So at Franklin Templeton, we have a suite of dividend tilt strategies where you're balancing the tracking error versus the investment universe and the dividend yield. So you're still getting a higher dividend yield, but you're not limiting yourself only to companies that pay higher yield. You actually run an optimization to be able to balance out the tracking error versus the investment universe while still delivering on the higher yield.
And so it feels like income has been one of the primary things that investors have been looking for, whether it's through T-bills sort of funds, whether it's through these options overlay ETFs. How has demand for dividends actually look like?
Yeah, so we were seeing over like 300 billion allocated to like income/dividend yield strategies. Within our lineup, our Divi product, DIVI, which is international developed dividend tilt strategies, we were seeing like close to like $500 million in net flows coming through. So income is an area that regardless of the environment people are looking for, and especially in the higher volatility environment that we're seeing right now, it gives you a little bit of downside protection as well as providing you the income that you're looking for.
There's a lot of talk about the S&P today. Emily Graffeo wrote a story about the fact that a lot of the companies in the S&P are smaller than companies in the S&P 400 mid-cap index. All of the gains are really about the big 7 getting bigger, right? Does diversification matter right now, or do you just have to make the right bet?
Diversification always matter, right? The fact that the S&P 500 is driven by these 7 companies actually is a challenge, right? It's not like that for 10 years ago. It's not like that 20 years ago. A company or an indices needs to be diversified because that's how you kind of believe in like the returns potential. Because if you're just relying on 7 to drive the contribution of return, which I heard the number is like 85% this year, right? it's not balanced, because imagine when it's doing well, of course it's good, but when it's not doing so well, then it's less so. So that's why we're always a big believer on like the mid-cap segment, and believer in a balanced approach, whether that's through a smart beta or through a combination of strategies around.
But even still, it just feels like all of the attention has been on the big seven. And I mean, how are you seeing that filter across these different
Hang on, we don't have
strategies?
time for any more questions.
Oh, no, I was just getting started.
There's only 20 seconds left.
Okay, never mind. We'll ask it next month.
We'll talk to you next week, right? Next week at 1 p.m., you can hear more from Dina Ting, head of Global Index Portfolio Management at Franklin Templeton ETFs. She's going to join me and Katie and Eric Balchunas on Bloomberg TV, ETF IQ.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's say hi to our next guest, Mark Douglas, CEO of Mountain. They call themselves the hardest working software in television. They build advertising software. I really do. I can remember back, Mark, it had to be like 50 years ago when we were first getting cable in the area, and my brother made the pitch to the old man saying, it's great, lots of sports, and they don't have advertising on cable. Now it's just like I feel the same thing is happening to me with streaming. What's the story?
Well, I mean, that works for the first three providers, which are willing to pay for maybe four. And then all the other cable channels, they're not getting any of that subscription money. So they have to have ads. And then it comes full circle. And the ones you weren't getting ads from were like, well, we could double our revenue if we add ads too. So we're just kind of back to the future. We're reliving that moment in cable, but we're doing it on streaming now.
Yeah, but I don't watch those ads. And Scarlett, I know your kids aren't watching the ads.
Gen Z is just angry about having to watch advertising because they've grown up where they haven't had to do it. And so when they're forced to sit through it, it's just, something that really gets at them. Is the advertising that they're going to see on streaming services going to be markedly different than what we got on network television in the 80s and 90s?
Yeah, I mean, it's literally exactly what my company Mountain does. So we democratize TV ads. So what you're going to see is a lot more advertisers, and they're all competing to get your attention. So they're going to be more entertaining. Instead of it just being kind of the same old beer brands and car brands, you're going to see a lot of emerging brands that are actually using television now on streaming to kind of basically just show you the products they have, but do it in a very entertaining way. So it is a bit different. You're also starting to see the ads get shorter. Netflix just announced like 10-second ad formats for their property. So, I mean, just expect more entertainment from the ads, more diversity of advertisers, and hopefully over time they get a lot shorter just to connect with that consumer.
Will it look more like Super Bowl ads, or are Super Bowl ads a thing unto themselves that won't be replicated anywhere else because of the budgets, because of the big audience?
Well, I mean, some of the best advertising that's coming out of my company have been for the, not huge amounts of money. Mm-hmm. We have Maximum Effort, Ryan Reynolds' ad agency is literally a part of Mountain. And so they do ads for as little as tens of thousands of dollars. And they, I think they might be doing a Super Bowl ad. So they do them for millions also. It just depends on the how much special effects and the actors and all that kind of stuff that controls the cost. The bottom line is if you have something, a product people are interested in, and you present it to them in an interesting way, people do actually respond to the advertising and go check out your product and potentially become a customer. And that's, at the end of the day, you're just trying to connect, like match consumers with brands they're potentially going to love. It's not like jingles anymore and just pushing brands on you. It's more about making that connection.
Is it right to say Netflix has sort of taken the lead on this? And if so, based on that, what is Disney hoping to achieve?
Well, I wouldn't say Netflix has taken the lead. I would say they have the most greenfield because they have no legacy business. Disney is kind of trapped in the upfronts and 30 seconds and 15-second formats, where Netflix is starting from scratch and they can just kind of reinvent what television advertising looks like. But that being said, it's not easy to do. And so they're out the gate struggling a little bit. But I think they will wind up becoming as innovative on the ad side of their business as they've been on the consumer side. The thing to remember with Netflix is they kind of reinvented the relationship between the consumer and the content, making it on, you no longer had to wait for the show. You could just binge it, all those kinds of things. And now they have an opportunity to do the same on advertising. It's to kind of reinvent the relationship between the advertiser, which funds all this programming for the ad-supported options on Netflix, and reinvent that relationship between the advertiser and the content. And I think they will. They've been a very innovative company for a very long time.
But what counts for innovation in
Good
advertising?
Question.
I mean,
yes.
Give me an example.
Yeah. So a lot has to do with the formats, I think. It's like, again, you don't have to sit there for 30 seconds. If you look at social, like if you look at ads on TikTok and you look at them on Instagram, even though they're both somewhat feeds, the ad content is very different. I think on TikTok, it feels much more like the content that you're scrolling through. Mm-hmm. On Instagram, it feels a little more traditional. There's a mix of video. So it's subtle changes that just make the ad format, again, feel like a form of the entertainment. So you're not like dreading the interruption. You're like kind of like hopefully entertained by it.
Yeah.
And one thing that makes the advertising, like something that we do, is what we call fast advertising, where the ads are, and this is like the maximum effort, where the ad content is like just extremely culturally relevant. It's like today's cultural news becomes literally tomorrow's ad. There's no delay. And so having that kind of support, we don't have to plan it a half year in advance. You can just come up with something right now and get it on the TV. I think that's pretty important. I think that's something Netflix and pretty much all networks are going to start to support.
So as we look ahead to Disney earnings on Wednesday, Mark, I wonder if Disney has room to innovate advertising on Disney Plus or ESPN Plus that really takes advantage of its different businesses, including theme parks. What can it do innovation-wise that other media companies, other streamers can't do?
Well, I think that they can do whatever they want. I think Bob Iger for quite a while now has been saying that he wants to kind of do away with the concept of an upfront, and he wants the advertisers to have a lot more freedom and just kind of Disney be where they want to be, not where they're trapped into an upfront contract. That being said, I think the first order of business at Disney is really to get all the business units operating like at their best. And, almost all of them have been struggling on some level for growth, for profitability. So, he'll probably, Disney, Bob Iger, that team there, they'll probably somewhat follow the same path as Netflix in terms of like, okay, we can innovate these ad formats. We don't have to stay stuck in the 30-second upfront format. But that being said, they have to get the viewers. People have to want to go and actually see the content before they want to see the ads.
Mark, always a pleasure. Appreciate it. Good to see you. Mark Douglas, CEO of Mountain. They call themselves the hardest working software in TV. And the new CFO, Disney.
Hugh Johnston, he's a Pepsi, I don't want to say lifer, but he's been there for decades. And I inducted him into the Hall of Fame of our high school.
Did
you really?
My classmate at CBA.
Wow, look at you guys.
Yeah, he's there and I'm here.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.